Risk Channels, discussions surrounding the insurance marketplace and what we need to do to stay ahead, to continue to make our families better, our personal lives better, grow our businesses, and fulfill our American dream. Let's get into it. Hey folks, and welcome back to the podcast. I'm your host, Mark Zettel. This week what we're going to do is we're going to repost a podcast from April of 2018, specifically on cyber liability. And the reason we're doing that is with the big breach of Collection One and the Ryuk ransomware attacks. I think it's important that we retouch upon that. So we'll put some information up on the site. We're going to repost the April 2018 podcast, again touching on cyber. So for you that didn't catch it the first time around, well, enjoy. We'll talk to you next week. Take care. Hey folks, and welcome back to the Risk Channels podcast. I'm Mark Zettel, and I'm your host. This week's episode, we're going to be discussing a little bit about cyber liability and some of the impacts it's having and how it's developing. That said, I think a good place to start is the definition, or a generalistic definition of what cyber is, and that being coverage for financial loss that results from a data breach or other cyber event. I think it's important just to note that obviously each policy's terms, conditions, and definitions would dictate a covered cause of loss and the definition in particular, so that's a good place to start as a generalistic definition. So cyber policies consist of a few different elements, one of those being first party and then the other being third party. Some first party coverage modules would consist of loss or damage to electronic data, loss of income or extra expense, cyber extortion, damage to the insured's reputation, and notification costs. Again, all of these are results of a cyber-related covered peril. Notification costs, obviously, I deem as very important because those costs can be extremely exorbitant if an insured is faced with a loss, coupled with the fact that state regulation, again, state to state, requires that in many cases they be notified of the loss or the breach to ensure that the consumer or customer that information has been breached is being handled appropriately and being taken care of. The other element or coverage models would be third-party models, such as network security liability, network privacy liability, E&O liability, and then electronic media liability, which would consist of things like patent infringement, several other, I'll call it, elements within that coverage module. So I guess the big question is, why is it important for companies to purchase cyber liability? And obviously in today's business landscape, technology is being utilized very heavily from a standpoint of online services. It could be e-commerce or even cloud-based computing. People are storing data in the cloud instead of buying their own servers and housing them in-house. They're storing their data on a cloud-based service to free up that space, as well as minimizing their operating expenses because now they don't have to maintain that database or those servers and buy that hardware. Also, transmitting of data through email. A lot of the personal and identifiable information, again, being stored in the cloud, is being transmitted via email. So I think with those exposures, it's in mind, it's important to maybe identify some of the carriers in particular that are participating in offering cyber liability coverage. So, Matt, why don't you hit on some of those carriers and we can pick it up from there.
Yeah, I'd be happy to do so. So I think a good way to start that conversation is to discuss the top 10 carriers writing this line of business. With that said, number 1, the head of this list is AIG. Number 2 is XL. Number 3 is Chubb. 4, Travelers. 5, Beasley. 6, CNA. 7, Liberty. 8 is BCS, 9 is Axis, and number 10 in the top 10 is Allied World. I also would like to point out, in terms of the demand for this line of business to be written, there are two notable jumpers in the top 150 carriers in terms of how they've been able to identify the need for this product, and that's Star International Companies, who in 2015 was the number 110 writer of this product, and in 2016 they jumped to number 18 in the top 25. Markel was another. 2015 they were the number 116 writer of this product, and they jumped to number 16 in 2006. By the way, this list of the top 10 writers is representative of 2016 data. Step 2 to this is to talk about the overall market size space of this product offering. And with that said, in 2016, there was $1.35 billion of direct premiums written for the cyber line of business. This was a 35% year-over-year growth in terms of direct premiums written from 2015, and I believe again a 30-some-odd% increase over 2014. So we can see this line of business, the demand, the need for it, and the writing of carriers is growing exponentially. Mm-hmm. Obviously, a dictate from the demand in the marketplace and how businesses are operating today. The issues with the carrier in terms of how they're offering this line of business and the demand for this product, it's altering the way in which they're offering and underwriting this line of business. And that has to do with the aggregation component. And what I mean by the aggregation component is where cyber starts and stops as a coverage. And meaning how it may potentially expose itself in other lines of business, such as the GL, where there's no
cyber exclusion
per se as it applies to the GL policy.
Yeah, I gotcha. So, like, well, actually, believe it or not, I've actually seen scenarios or even read about them where coverage lines such as GL did not have a specific cyber exclusion or crime, and while it might have been the carrier's initial intent not to provide cyber coverage, because there was no specific exclusion when that claim was made, the carrier originally denied coverage, and then a motion was brought to overturn, I'll call it that, finding. The carriers actually got stuck with paying because the courts deemed that the four corners of the policy dictates and that there was no cyber exclusion, and therefore, again, getting back to your point about the aggregation amongst coverage lines, what carriers are now doing to get around that, though, is they are in particular making sure that they add on a cyber exclusion to the applicable coverage lines, so there is no aggregation or contribution from policies where the intent may not have originally been to provide coverage.
Exactly. And another element or talking point to that is they will offer those policies one of two ways. They'll offer the cyber coverage as part of a multi-peril bundled coverage offering, or they'll offer cyber on a standalone basis. The direction that most of them are going is offering it on a standalone basis. Again, another statistic, in 2016, 67% of these policies were written on a standalone basis. Wow. So they're deviating away from the multi-peril offering, where they're embedding cyber into other types of coverage offerings to safeguard, again, against the aggregation effect.
Gotcha. So I think maybe now that we have a grasp on, obviously not everybody that's writing it, but who is writing it and how it's growing exponentially, and how we can obviously see it as being something that I'll call it as a necessity given the business landscape of today. How are companies writing it, Matt? Like, what are you seeing, or what is your feeling on, it's in its infancy stages. So obviously they can't do the same type of modeling that they are doing on property, that they have hundreds and hundreds of years of data. So what are you seeing that they're utilizing to kind of develop their modeling?
Well, I think that's really the crucial question, and a lot of carriers are correlating and associating cyber coverage and the cyber exposure very much so with catastrophe and property exposures of the past, which, to your prior point, is a line of business that carriers have hundreds of years of historical data on to help adequately model for. Mm-hmm. The issue with cyber is it's very, very new. It's in its infancies and it's evolving every day. So that historical data pool isn't as significant as something like catastrophe property insurance, for example, which creates a conundrum for actuarial departments in how to adequately model. That again leeways into the aggregation issue, which is essentially a capacity issue for carriers. How to be able to afford knowing that aggregation if issue is in play, which is essentially a systematic issue. How to plan accordingly for that, and what carriers are doing, and I've seen some examples of this, are looking for third-party capital through the capital markets to provide additional capital into the space. So like a catastrophe bond offering would be an example of something like this, where you're going to hedge funds and asset managers and pension funds and asking them to provide capital in the event of something like a cyber loss, so that, again, you have that additional capital flowing into the space to safeguard against that aggregation element, if you will.
So the carriers basically are going outside to find, I'll call it additional capacity, which means that because they can't model it, they're essentially identifying that there is this potential for a much greater loss or exposure than they can even contemplate at this point, which kind of leads me back to, well, how do the insureds identify what their potential exposure is when procuring the coverage? So,
I think you pointed out a great example in your introduction to this topic, and that's the usage, for example, of cloud systems for your data storage. Cloud systems for your data storage, whoever that provider of that system is, houses the information of potentially, hundreds of thousands of businesses. Yeah. So if they were to be breached, hundreds of thousands of compromising proprietary information of those individuals and businesses are also collectively
at risk.
And there have been statistical, we'll call it projections of what a loss like that would look like. And Lloyd's, for example, did a projection of what a cloud service breach would look like in a matter of only a few days, and that was something to the tune of north of like $50 billion or so.
Yeah.
We're talking $50 billion in potential losses in a matter of a few days. So that's just kind of gives you more of a clarified lens of what we're
there's a perfect example. I did read that Symantec is or has provided or come up with a framework to help both insurers and insureds try to gauge their potential for loss utilizing what they call the CUBE framework, and it's comprised of basically 6 elements, which I'm not going to get into, but obviously you listeners can look that up. It's CUBE, CUBE. Symantec is the developer of it, but that obviously is helping both insureds and insurers. But again, because this line of business, it's in its infancy stages. Even with that framework, it's still very difficult for them to forecast or model real potential losses. So, you throw that number out there of 50 some odd billion in a few days. Yeah, that's scary, but it could be even more than that, especially with cyber being a worldwide, I'll call it epidemic. It's not something that's limited to a specific location, i.e. property. One building burns down, what the max payout's going to be. Certain liability losses, there's actuarial data on different types of losses. Mm-hmm. The reality of this is it's still too young to really forecast what the potential is.
The other issue to talk about is who is impacted by it, because sometimes there's a naiveness of when we hear in the media the Targets of the world and the Target breaches and Citibank and J.P. Morgan,
Yeah.
people deem to think that these big we'll call it corporate institutions are the only ones impacted.
Yeah.
But what they don't take into account is those institutions, in the operation of their underlying infrastructural technologies, they outsource that to third-party vendors, which are smaller to mid-sized firms. And in the case of Target, for example, it was deemed and the finger was pointed at one of the smaller vendors that they used who essentially was responsible for that breach.
Yeah. I would actually say that I think that in my own dealings, risk managers of larger firms, larger privately held or publicly traded firms, they have more of a keen awareness and obviously the dollars to throw at their infrastructure, or for that matter to try to combat this, whether it be through risk transfer insurance contracts or just to fight it at the ground level. Whereas a small business owner or medium-sized business owner, every dollar that goes into their pocket, it's harder to separate with because they're not
as capital flush as a larger entity.
They just don't have the dollars to throw at it, and and even beyond that, they just sometimes don't see their vulnerabilities or how it's beneficial, and that doesn't just lie with cyber liability. That goes on to other coverages as well, but cyber being a newer one, which quite frankly they're even more adverse to, because again, they don't see their exposure. Perfect example is I work with some vending machine operators that use third parties to process credit card transactions, and even there, they feel that because the third party is processing the credit card transaction that they do not have an exposure. Well, I'm not going to tell you what is and is not covered, but I will say that if there is some kind of reading mechanism put on that vending machine that's taking that credit card information by a hacker, well, the third-party processor wasn't the one that lost that data. So where's their exposure exactly in that claim? I mean, that doesn't sound like the third-party processor is gonna be partaking in it. But again, it's about educating and showing these small business owners and people that are running these medium-sized companies, where their exposures are.
You touched on an important point with the contractual structuring. These larger entities have the ability to fine-tune the contracts to a vendor in their favor, so they have more of a downstream effect where the vendor might not be so aware of the exposure that they're essentially bearing in, we'll call it a cyber-related loss type of situation in terms of what they're inheriting.
Well, yeah, I mean, think about it. They have a legal team to these larger companies to draft these contracts. So, everything, without saying it flows downhill, if you know where I'm going.
Exactly.
So I guess to kind of sum things up, obviously all size companies, small, medium, large, publicly traded, whatever they may be, have some form of cyber exposure, whether they realize it or not. And I think from a agent broker standpoint, it's important to speak to your insurers about it, give them some scenarios, really delve into it. As an insured listening, you may want to inquire with your agent or broker into the coverage. What other elements are available to help protect you better? And I think with the insureds, agents, brokers working in conjunction with carrier underwriters, you could really develop a good program, even still not having all of the actuarial statistical data. There still can be some form of program developed that could help transfer some of the risk. Folks, thanks for listening. We'll be getting back to you next week, but we do appreciate the listening this week. Hope you have a good week. Take care.